Welcome to the 22nd installment of the Beginner Tutorial Series. Today, we're going back to the absolute foundation of how most traders view the markets. We're talking about candlestick charts, the most powerful and popular charting method in the world. Let me start with a question. Imagine you could look at a single symbol and instantly know, did buyers or sellers win the battle? How aggressively did they win? Were there moments of rejection or indecision? And what might happen next? That's exactly what a candlestick gives you. Each candle is a story, a capsule of market psychology compressed into a visual form that you can read at a glance. This isn't modern technology. This technique was developed over 300 years ago by a Japanese rice trader named Munehisa Homa. And it's still used today by millions of traders across stocks, futures, crypto, and forex.
Why?
Because human psychology hasn't changed. Fear and greed look the same today as they did in 18th century Japan. By the end of this presentation, you'll be able to identify every part of a candlestick and what it means, read the story each candle tells about the battle between buyers and sellers, distinguish between significant and insignificant candles, and use candlestick analysis to inform your trading decisions. Let's begin. Before we go any further, let me take a moment to explain why mastering candlestick structure is not just another lesson. It's arguably the most important foundation you will ever build as a trader. Think of candlestick mastery as learning to read the alphabet before you can read a book. But let me give you 4 specific reasons why this matters so much. Reason 1. Candlesticks are the universal language of markets. Whether you trade forex, stocks, futures, cryptocurrencies, or commodities, candlesticks work the same way. A hammer in the S&P 500 means the same thing as a hammer in euro to US dollar. A shooting star in Bitcoin means the same thing as a shooting star in gold. Once you learn this language, you can trade any market. You're not locked into one instrument. Reason 2. Candlesticks reveal the psychology behind the price. Most indicators are lagging, they tell you what happened after it happened. But candlesticks show you the battle in real time. You see the fear in a long upper wick. You see the greed in a long bullish body. You see the indecision in a doji. You're not just looking at numbers, you're looking at human emotion frozen in time on a chart. That's an edge that pure indicator traders don't have. Reason 3. Candlesticks form the building blocks of every pattern. Every complex pattern you will ever learn, from head and shoulders to flags to wedges, is composed of individual candlesticks. If you don't understand the building blocks, you can't truly understand the patterns. It's like trying to understand a novel when you don't know what the words mean. Master the individual candles first, and everything else becomes easier. Reason 4. Candlesticks work across all time frames. The same principles that apply to a 1-minute chart apply to a monthly chart. A hammer on a 5-minute chart shows the same psychology as a hammer on a weekly chart. The time frame changes the significance. Higher time frames are more reliable, but the meaning doesn't change. This consistency means you can use candlestick analysis whether you're a scalper, a day trader, a swing trader, or a position trader. Here's the bottom line. Candlestick mastery is not optional. It is the foundation upon which all other technical analysis is built. Skip this foundation, and everything you build above it will be unstable. Take the time to truly understand each candle. Practice identifying bodies, wicks, and patterns. The traders who do this consistently outperform those who don't. Period. Before we dive into the structure of a candlestick, let's take a quick journey back in time. Understanding where candlesticks came from helps us understand why they still work. The 1700s, Dojima Rice Exchange, Osaka, Japan. A rice trader named Munehisa Homa made a revolutionary discovery. At the time, most people believed price was determined purely by supply and demand, how much rice was available versus how much people wanted to buy. But Homa noticed something different. He observed that prices were also driven by emotion, fear, and greed. He saw that patterns of price movement repeated over time because human psychology repeated. So he developed a visual way to record the open, high, low, and close of rice prices. That was the birth of the candlestick. The 1980s. Introduction to the West. For centuries, Candlestick charting remained largely unknown outside Japan. Then, in the 1980s, a trader named Steve Nyssen discovered these techniques and introduced them to the Western world through his books and seminars. The impact was immediate. Traders realized they had been missing a powerful tool for understanding market psychology. Today, global standard. Now, candlesticks are the default chart type on every major trading platform: MetaTrader, TradingView, CTrader, you name it. They're used by millions of traders across forex, stocks, futures, and cryptocurrencies. Why has this 300-year-old technique endured? Because human psychology hasn't changed. Fear and greed look the same on a chart today as they did on a rice ledger in 18th century Japan. That's the power of candlesticks. So why have candlesticks become the dominant chart type? Let me show you. Compare these three charts, showing the exact same price data. A line chart connects only the closing prices. It's simple, but you lose a lot of information. You can't see the highs, the lows, or how the candle opened. A bar chart shows all four prices: open, high, low, close. But it's not intuitive. You have to study each bar to understand what happened. A candlestick chart shows the same four prices, but in a visual format that your brain processes instantly. You can see at a glance whether buyers or sellers won, how decisively they won, and whether there was rejection at the highs or lows. That's the visual advantage. Here are candlesticks' key advantages and why it matters. They include: 1. Intuitive. Bull or bear dominance is visible immediately. 2. Pattern-rich. There are dozens of recognizable formations. 3. Psychological. Wicks show rejection. Bodies show conviction. 4. Universal. Works on any time frame, any market. 5. Historical. Candlesticks have centuries of proven reliability. Now, let's look at the anatomy of a single candlestick. Every candlestick has four critical prices and two main visual elements. The body is the thick part. It spans from the open price to the close price. It shows the net result of the battle between buyers and sellers. The upper wick, also called the upper shadow or tail, extends from the top of the body to the high of the period. It shows how far buyers pushed price and whether they were rejected. The lower wick extends from the bottom of the body to the low of the period. It shows how far sellers pushed price and whether they were rejected. The open is the first price of the period, where the battle started. The close is the last price of the period, where the battle ended. The high is the highest price reached, how far bulls pushed. The low is the lowest price reached, how far bears pushed. Together, these four prices and two visual elements tell a complete story of the battle between buyers and sellers during that period. Now, let's dive deeper into the most visible part of the candle, the body. The body represents the range from the open price to the close price. It shows the net result of the battle between buyers and sellers during that period. A long bullish body, a tall green candle, tells us several things. Buyers were aggressive. They opened somewhere, pushed price significantly higher, and closed near the high. Sellers couldn't push price back down. This shows strong momentum, and it suggests that the trend is likely to continue in the same direction. A long bearish body, a tall red candle, tells us the opposite. Sellers were aggressive. They pushed price significantly lower and closed near the low. Buyers couldn't mount a recovery. Again, strong momentum favoring the direction of the body. A short body, a small candle, whether green or red, tells us there was no clear winner. The open and close were close together. This indicates weak momentum and indecision. The market is pausing, consolidating, or possibly preparing for a reversal. Here's a key insight. The longer the body, the more decisive the victory. A long body shows conviction. A short body shows uncertainty. And remember, bullish means the close is higher than the open, regardless of what color your platform uses. Bearish means the close is lower than the open. While the body tells us who won, the wicks, also called shadows or tails, tell us about the journey. They show the full range of price movement and, most importantly, where price was rejected. A long upper wick means that at some point during the period, buyers pushed price significantly higher. But then sellers stepped in and pushed price back down. The longer the upper wick, the more aggressive the rejection. This is especially significant if it appears after an uptrend or at a known resistance level. It suggests that sellers are defending that level. A long lower wick is the opposite. It means sellers pushed price significantly lower, but buyers stepped in and brought it back up. This shows buying pressure and rejection of lower prices. It's especially significant after a downtrend or at a known support level. No wicks, what we call a Maribozu, means there was no rejection at all. The candle opened at one extreme and closed at the other. One side was in complete control from beginning to end. This shows strong conviction. Very long wicks, wicks that are longer than the body, indicate intense rejection. These often mark key levels where the market has decided that price won't go further. Here's the key insight about wicks. They show you where the market tried to go but failed. That failure is valuable information. A long upper wick tells you there are sellers waiting at those higher prices. A long lower wick tells you there are buyers waiting at those lower prices. Now, let's talk about the range, the total distance from the highest high to the lowest low of the candle. The range represents the full volatility of the period. A wide range, a large distance from high to low, tells you there was high volatility and strong emotion. Buyers and sellers were fighting aggressively. This is common during news events or at the start of new trends. A narrow range, a small distance from high to low, tells you the market was quiet. Low volatility. This often happens during consolidation or holiday periods when traders are waiting for something to happen. But here's where it gets really interesting, the relationship between the body size and the total range. We call this the body-to-range ratio. It's calculated by dividing the body size by the total range. A high ratio, above 70%, means the body takes up most of the candle. This shows strong conviction. The winning side controlled price for most of the period. There was little rejection. A moderate ratio, 30% to 70%, means the body is a significant but not dominant part of the candle. There was some indecision or rejection, but one side still won. A low ratio, below 30%, means the body is small relative to the range. The losing side pushed price significantly at some point, even though they ultimately lost. This shows weak conviction. A 0% ratio, a doji, means the open and close were equal. Complete indecision. Neither side won. This ratio helps you distinguish between a decisive victory and a messy, contested one. Two candles can both be bullish, but one with an 80% ratio shows much stronger conviction than one with a 30% ratio. Let's cover the most basic distinction: bullish versus bearish candles. A bullish candle forms when the close price is higher than the open price. This means buyers controlled more of the period than sellers. The candle is typically colored green, white, or hollow, depending on your platform. A bearish candle forms when the close price is lower than the open price. This means sellers controlled more of the period than buyers. The candle is typically colored red, black, or filled. Now, a very important note about colors. Different platforms use different color conventions. The original MetaTrader default used white for bullish and black for bearish. Most modern platforms, including the ones Algonic integrates with, use green for bullish and red for bearish. But the color itself is just a convention. What matters is the relationship between open and close. If close is higher than open, it's bullish regardless of whether it's green, white, or purple. If close is lower than open, it's bearish regardless of whether it's red, black, or blue. Don't get distracted by colors. Focus on the open-close relationship. A quick word on hollow versus filled candles. Some platforms use hollow candles for bullish, meaning the body is empty, and filled candles for bearish, meaning the body is solid. This is just another convention. The underlying meaning is the same. Now, let's put everything together and talk about how size and position tell the complete story. First, body size. A long body shows strong momentum and clear direction. If you see a long bullish body in an uptrend, it confirms the trend and suggests continuation. If you see a long bearish body in a downtrend, the same applies. A short body shows weak momentum and indecision. After a long trend, a short body can signal exhaustion. The market may be preparing to reverse or consolidate. Short bodies often appear at turning points. Second, wick length in context. A long upper wick always means the same thing. Price moved higher, then was rejected. But the significance depends on context. After an uptrend, a long upper wick is a warning. Sellers are stepping in. At a resistance level, it confirms that resistance is strong. In the middle of a downtrend, it might just be a temporary pullback. A long lower wick means price moved lower, then was rejected. After a downtrend, it's a bullish signal. Buyers are stepping in. At a support level, it confirms that support is strong. Third, the position of the body within the range. A body at the top of the range with little or no upper wick means price closed near the high. This shows strong bullish sentiment. The bulls didn't just win. They won and held their ground. A body at the bottom of the range with little or no lower wick means price closed near the low. This shows strong bearish sentiment. A body centered in the range with wicks on both sides shows indecision. The market went up and down and settled in the middle. The key insight: a long wick shows you where the market tried to go but failed. That failure is valuable information. It tells you where the sellers are waiting, upper wick, or where the buyers are waiting, lower wick. Now, let's bring all these concepts together into a practical framework for reading any single candle. When you look at a candle, ask yourself 4 questions. Question 1, who won? Is the body bullish, closed open, or bearish, close open? This tells you which side had the net advantage. Question 2, how decisively? Is the body long or short? A long body shows a decisive victory. A short body shows a narrow victory or indecision. Question 3, was there rejection? Look at the wicks. A long upper wick shows rejection of higher prices. A long lower wick shows rejection of lower prices. Long wicks on both sides show intense battle and indecision. Question 4, where did it close? Is the body at the top, bottom, or center of the range? Closing near the high shows strength. Closing near the low shows weakness. Closing in the center shows indecision. Now, let's introduce some of the key single candle patterns you'll encounter. The doji. Open equals close. Complete indecision. But remember the doji rule. A doji alone is not a signal. It must be confirmed by the next candle. The Maribozu, no wicks at all. Complete conviction. One side was in control from open to close. The hammer, a small body at the top with a long lower wick, appearing after a downtrend. This shows buyers stepping in to reject lower prices. Bullish reversal signal. The shooting star, the same shape as a hammer, but appearing after an uptrend. This shows sellers stepping in to reject higher prices. Bearish reversal signal. The engulfing pattern, a large candle that completely covers the previous candle's body. This shows a complete shift in sentiment. We'll cover all of these patterns and more in the next module. For now, focus on the 4 questions. Master those, and you'll be able to read any candle that appears on your chart. Now that you understand single candles, their bodies, wicks, and what they reveal, let's see how multiple candles combine to tell even richer stories. We're moving from letters to words to complete sentences. The patterns we're about to cover fall into 2 categories: reversal patterns, which signal that the trend is about to change direction, and continuation patterns, which signal that the trend will resume after a pause. Remember the golden rule: you cannot have a reversal without a trend to reverse. Always identify the trend first, and always wait for confirmation from the next candle. Engulfing patterns are among the most reliable reversal signals in all of technical analysis. They show a complete and dramatic shift in market sentiment. Bullish engulfing. This pattern forms in a downtrend. The first candle is a small red candle. Bears are in control. The downtrend continues. Then something dramatic happens. The second candle is a large green candle that completely engulfs the body of the first candle. Not just the shadows, the actual body. The green body must completely cover the red body. The psychology is a complete shift in sentiment. On day 1, bears were winning. On day 2, bulls stepped in with such force that they wiped out the previous day's entire move. The larger the second candle, the stronger the signal. And the more volume on that second candle, the more reliable the pattern. Bearish engulfing. The bearish engulfing pattern is the exact opposite. It forms in an uptrend. The first candle is a small green candle. Bulls are in control. The second candle is a large red candle that completely engulfs the body of the first candle. The psychology: bulls were driving price higher, but then bears stepped in with overwhelming force. The large red candle shows that sellers have taken complete control. Trading implications: both engulfing patterns are high-probability reversal signals. But remember the rules. They must appear after a clear trend. They must have a large second candle. The larger the better. And you must wait for confirmation from the next candle moving in the expected direction. When you see a bullish engulfing after a downtrend, with confirmation, it's a strong buy signal. When you see a bearish engulfing after an uptrend, with confirmation, it's a strong sell signal. Harami patterns are the opposite of engulfing patterns. In Japanese, harami means pregnant. The first candle is the mother, large and dominant. The second candle is the baby, small and contained entirely within the mother's body. Bullish harami. This pattern forms in a downtrend. The first candle is a large red candle, strong bearish momentum. The second candle is a small candle, it can be green or red, that trades entirely within the body of the first red candle. The psychology: bearish momentum is slowing. The bears pushed hard on day 1, but on day 2, they couldn't push price further. The small candle shows indecision and exhaustion. The downtrend may be running out of steam. Bearish harami. This pattern forms in an uptrend. The first candle is a large green candle, strong bullish momentum. The second candle is a small candle that trades entirely within the body of the first green candle. The psychology: bullish momentum is slowing. The bulls pushed hard on day 1, but on day 2, they couldn't push price higher. The uptrend may be running out of steam. Harami versus engulfing. The key difference: engulfing patterns show a complete reversal of sentiment. Harami patterns show momentum slowing. Engulfing is stronger. Harami is more tentative. A harami requires stronger confirmation from the third candle, ideally a move in the opposite direction of the prior trend. Think of it this way. Engulfing says the trend has reversed. Harami says the trend might be running out of gas. Both are useful, but they have different implications for your trading. The piercing line and dark cloud cover are two candle reversal patterns that involve a specific threshold, the 50% level of the first candle's body. Piercing line bullish. The piercing line forms in a downtrend. Day 1 is a red candle. Downtrend continues. Day 2 opens lower than the previous close, which initially suggests more selling pressure. But then buyers step in aggressively, pushing price up to close above the midpoint, the 50% level, of the first candle's body. The psychology is critical. The fact that price opened lower shows that bears were still in control at the start of day 2. But the fact that it closed above the midpoint of the previous candle shows that buyers completely overwhelmed them. The deeper the second candle closes into the first candle's body, the stronger the signal. A close above 70% is even more bullish than 50%. Dark cloud cover, bearish. The dark cloud cover is the bearish equivalent. It forms in an uptrend. Day 1 is a green candle. Uptrend continues. Day 2 opens higher than the previous close, which initially suggests more buying pressure. But then sellers step in aggressively, pushing price down to close below the midpoint of the first candle's body. The psychology: bulls were in control at the open, but sellers rejected those higher prices and drove the market down through the halfway point of the previous rally. A close below 30% is even more bearish than 50%. The 50% threshold. Why is the 50% threshold important? Because it shows that the reversal isn't just a minor pullback. The second candle has erased at least half of the previous candle's move. This demonstrates real conviction from the opposing side. Both patterns require confirmation from the next candle. For a piercing line, the next candle should close higher. For a dark cloud cover, the next candle should close lower. The morning star and evening star are 3-candle reversal patterns. They are among the most reliable patterns in all of technical analysis, masterpieces of market storytelling. Morning star, bullish. The morning star appears after a downtrend. It tells the story of a complete reversal from bearish to bullish. Candle 1 is a long red candle. Bears are in firm control. The downtrend has strong momentum. Candle 2 is a small-bodied candle. It can be a doji, a spinning top, or any small candle. This candle often gaps down from the first candle, opening lower. The psychology here is indecision. The downtrend momentum is slowing. The bears couldn't push price significantly lower. Candle 3 is a long green candle that closes at least halfway into the first candle's body and ideally closes above the midpoint. This is the confirmation. Bulls have taken control. The name, Morning Star, signals the dawn of a new uptrend after the darkness of a downtrend. Evening Star, bearish. The evening star appears after an uptrend. It tells the story of a complete reversal from bullish to bearish. Candle 1 is a long green candle. Bulls are in firm control. The uptrend has strong momentum. Candle 2 is a small-bodied candle, often gapping up from the first candle. This shows indecision. The uptrend momentum is slowing. Candle 3 is a long red candle that closes at least halfway into the first candle's body. This confirms that bears have taken control. The name Evening Star signals the end of the day, the end of the uptrend. Reliability. Both patterns have very high reliability, especially when the second candle is a doji and when volume increases on the third candle. But they are also relatively rare. When you see one, pay attention. Always wait for the third candle to close before considering an entry. The third candle is your confirmation. A gap occurs when a candle's open price is significantly different from the previous candle's close, with no trading in between. Gaps represent emotional extremes, news events, or imbalances in supply and demand. There are 4 types of gaps, and recognizing them can give you an edge. Common gap. A common gap appears within a trading range or consolidation. It's usually small and gets filled quickly. These gaps have low significance. They're just normal market noise. Don't read too much into them. Breakaway gap. A breakaway gap occurs when price gaps out of a consolidation pattern or trading range. This signals the start of a new trend. The psychology. One side has finally won the battle after a period of indecision. Breakaway gaps are significant. They often mark the beginning of a major move. Runaway gap, also called measuring gap. A runaway gap appears in the middle of a strong trend. It shows that the trend is accelerating. Momentum traders love runaway gaps because they confirm that the trend is strong and likely to continue. In classical technical analysis, runaway gaps often occur at the midpoint of a trend move. Exhaustion gap. An exhaustion gap appears near the end of a trend. It's a final, often dramatic gap in the direction of the trend, but it's quickly reversed. The psychology. The last of the believers have entered the trend, and there's no one left to push price further. Exhaustion gaps often fill within a few days and signal an impending reversal. Gap trading considerations. In Forex, gaps are most common over weekends when markets are closed. News events can cause gaps during the week as well. When you see a gap, ask yourself, where is it occurring? Is it breaking out of consolidation, breakaway? Is it in the middle of a strong trend, runaway? Or is it after a prolonged move, exhaustion? The answer will tell you whether the gap is a signal to enter, add to a position, or take profits. Important note, in Forex, unlike stocks, gaps don't always fill. The old adage, gaps always fill, is not true in currency markets. Trade gaps based on their context, not on an expectation of filling. Even experienced traders fall victim to misconceptions about candlesticks. Let me clear up the 6 most common ones. Misconception 1. Every doji reverses the trend. I see this all the time. A trader sees a doji and immediately assumes the trend is about to reverse. That's not what a doji means. A doji shows indecision. Nothing more, nothing less. It tells you that neither buyers nor sellers won the battle. But indecision does not guarantee reversal. The market could continue in the same direction after a brief pause. The only way to know is to wait for the next candle. If the next candle closes in the opposite direction of the prior trend, then you have a potential reversal. The doji alone is not enough. Misconception 2. Long wicks always mean reversal. Long wicks show rejection, but rejection doesn't always lead to reversal. In a strong trend, You will see long wicks as normal pullbacks. For example, in a powerful uptrend, you might see candles with long upper wicks, buyers pushed up, sellers pushed back. But the trend continues higher anyway. The key is context. A long upper wick after a prolonged uptrend at a resistance level is significant. A long upper wick in the middle of a strong trend might just be noise. Misconception 3. Patterns work in isolation. This is dangerous. Many new traders see a hammer or an engulfing pattern and immediately enter a trade without checking anything else. Patterns do not work in isolation. They need confirmation from the next candle, alignment with the trend, significance from support or resistance levels, and ideally volume confirmation. A pattern at a random level in a sideways market is weak. The same pattern at a key level after a strong trend is powerful. Context is everything. Misconception 4. Candles predict the future. Candlesticks are descriptive, not predictive. They tell you what happened during the period, who won, how decisively, whether there was rejection. Based on that description, you can make an educated guess about what might happen next. But candles do not guarantee anything. A perfect hammer after a downtrend still fails about 30% of the time. That's why you use stop losses. That's why you size positions appropriately. Respect what candles describe, but don't worship them as prophets. Misconception 5. All time frames are equal. A pattern on a 5-minute chart is not the same as a pattern on a daily chart. Higher time frames represent more data and more significant price movements. A daily hammer represents the entire day's battle between buyers and sellers. A 5-minute hammer represents just 5 minutes of that battle. The higher the time frame, the more reliable the pattern. That doesn't mean lower time frames are useless. Scalpers and day traders use them effectively. But it does mean you should always check the higher time frame trend before acting on a lower time frame pattern. A bullish pattern on a 5-minute chart means very little if the daily chart is in a strong downtrend. Misconception 6. Bullish means green. Bearish means red. This is a convention, not a rule. Different platforms use different colors. The original MetaTrader used white for bullish and black for bearish. Some platforms use blue and orange. The color itself is irrelevant. What matters is the relationship between the open and close. If the close is higher than the open, it's bullish regardless of whether it's green, white, or purple. If the close is lower than the open, it's bearish regardless of whether it's red, black, or blue. Don't let color distract you from the actual price relationship. The takeaway: candlesticks are powerful tools, but they are not magic. They work best when you understand their limitations, when you use them in context, and when you always seek confirmation. Let's bring everything together. You now have a complete framework for understanding and analyzing candlestick charts. Here's your candlestick framework. 5 steps to follow every time you look at a chart. Step 1. Start with the basics. Identify who won, bullish or bearish body. Measure how decisively, body length. Examine the wicks. Was there rejection? Note the close position. Where did price settle? Step 2. Consider context. What is the overall trend? Are we at support or resistance? What candles came before? What follows? A hammer after a downtrend means something completely different from a hammer in a sideways market. Step 3. Learn patterns gradually. Master single candles first. Then learn 2-candle patterns. Then 3-candle patterns. Don't try to memorize everything at once. Practice recognizing them in real time on your charts. Step 4. Always seek confirmation. No single candle alone is a trading signal. Wait for the next candle to confirm. Consider the trend and key levels. Use multiple time frame analysis. Step 5. Keep a journal. Annotate the candles you trade. Note why you entered and exited. Review what worked and what didn't. Refine your understanding over time. And here's your pre-trade checklist. Before you act on any candlestick signal, ask yourself these 5 questions. Have I identified the pattern correctly? Is this at a key support or resistance level? Does it align with the higher time frame trend? Is there confirmation from the next candle? Is volume supporting the move? If you can answer yes to all 5, you have a high probability setup. How Algonic helps you put this into practice. You don't need to memorize every pattern or stare at charts for hours. The Algonic platform includes automated pattern recognition tools that identifies candlestick patterns across multiple pairs and time frames. The context overlay shows you how patterns relate to key support and resistance levels. And the journal integration lets you save annotated candles directly to your trading journal for later review. Let me leave you with this final thought. Each candlestick is a story. It tells you who won the battle, how decisively they won, and whether there were moments of rejection. Learn to read these stories, and the market will begin to speak to you. Your next tutorial will build on this foundation. We'll cover candlestick patterns, how multiple candles combine to form even richer stories of reversal, continuation, and indecision. Thank you for your attention. I'm happy to take any questions.